Imagine you're betting on a racehorse, right? You get all the thrill of the sprint, but you never have to actually feed it, stable it, or shovel up after it.
Yeah, that is exactly the appeal of a gold CFD.
Right, because you get that pure speed of price action without the logistical nightmare of vaulting physical bullion, paying dealer spreads, all of that. So today our mission for this deep dive is taking your sources and decoding how to actually trade this instrument with structure instead of just, throwing darts.
And that speed we're talking about, it comes entirely from leverage, which honestly acts like strapping a massive jet engine to a very small boat.
Oh, wow. Okay.
I mean, gets you to the finish line instantly if you're pointed in the right direction, but the slightest wrong turn just flips the whole vessel. You're controlling this huge position with just a fraction of the capital.
Meaning a tiny adverse price swing can aggressively wipe out your margin.
Exactly. It's a total double-edged sword.
And because that leverage is so unforgiving, I feel like stepping into the market without understanding gold's erratic personality is basically financial suicide. The guide paints gold as this highly erratic asset. It plays the role of a macro indicator, a defensive bunker, and a purely speculative toy, all at the same time.
It really does. It's got multiple personalities.
Right, but I actually have to push back on the fundamental rules here because the text states gold and the US dollar typically move inversely.
Right, they usually do.
But then, just a few paragraphs later, it warns that they can suddenly surge together during broad risk stress. So if the fundamental rules just snapped during a panic, how can a trader possibly trust a trend?
Well, you survive by accepting that rigid rules will eventually blow up your account. I mean, gold doesn't just blindly react to the dollar. It reacts to real yields and, fear.
Okay, so it's more about the underlying emotion in the market.
Exactly. Because gold pays no interest, it's constantly competing with assets that do, like U.S. Treasuries. Yeah. But in a true, terrifying global panic, like a sudden geopolitical shock, investors dump everything in a desperate dash for cash.
So they flood into both the US dollar and gold simultaneously just to preserve their capital.
Yeah, exactly. And the secret to surviving that environment isn't predicting it. It's waiting out the initial shockwave. The first massive price spike after a headline hits is mostly driven by algorithms and panic.
Wow, so it's rarely the lasting trend.
Almost never. You have to let the dust settle.
Right, the dust has to settle before the real trend emerges. And since gold's drivers are so contradictory and prone to flipping on just a single economic release, survival entirely comes down to position sizing, right?
Completely.
There's this huge aha moment in the guide about a brutal trap for retail traders. They size a trade based on the profit they want to make rather than the loss their account can actually survive.
Oh, it's the most common mistake. To fix that, you have to build your trades backward. It starts with a concrete thesis, like softer U.S. inflation data will drop bond yields, making gold more attractive.
Right, you need a specific reason to enter.
Yeah, and once you have that, you look at the chart to find your entry and, crucially, your invalidation point. If your thesis breaks when gold drops below $2,000 an ounce, that is your hard stop loss.
Got it.
Then you apply the math. So if your strict rule is to risk a maximum of $100 per trade, you calculate the distance between your entry price and that $2,000 stop. You mathematically size your CFD lot so that specific distance equals exactly $100.
And if the math dictates that a meaningful position size would risk, say, $200, you just don't take the trade.
Exactly. You walk away.
You don't arbitrarily widen the stop just to get in on the action.
No, because doing that turns a calculated business decision into an emotional gamble.
Yeah.
And, the same discipline applies to technical indicators.
Oh, like what?
Well, a common trap is shorting gold simply because the Relative Strength Index, or RSI, shows it's overbought. I mean, RSI measures momentum, but in a geopolitical panic, fear completely overrides technical bounds. Gold can stay overbought for weeks.
That's crazy.
It is. You need a stable environment to execute these precise plans, which is why the source highlights using a robust multi-asset broker like Monaxa.
Right, because platform stability is non-negotiable. When the London and New York sessions overlap, liquidity thins out and spreads violently widen.
Exactly. You can't be fighting your broker and the market at the same time.
Totally. Ultimately, mastering gold isn't about capturing the excitement of a volatile market. It's about protecting your downside through ruthless, emotionless math.
You really just have to respect the volatility, wait for the noise to clear, and never force a setup when the macro environment is screaming at you to stay out.
Which leaves us with a final thought for you to chew on. If gold constantly shapeshifts between being an inflation hedge, a safe haven, and a speculative toy, which of these personalities will completely hijack the market during the next major global crisis? And when that happens, will traditional chart setups even matter, or will that horse just break entirely out of the stable? Keep questioning the charts.